Could be very important video to you, so try to stay focused with me. We all know that there is a ton of Bitcoin models out there. Some of them doesn't make sense, and some of them really have a good idea they are built on. And those models is what we will have in this video. In the last video we talked about one of the most famous Bitcoin price model. So in this video I will talk about one of the most important in my opinion, and most of people doesn't know anything about it, which is the Bitcoin production cost. One of my favorite models or indicators. It's used often to determine the bottom of the market, but it had nothing to do with the price peaks. And we will know why. Now please lend me your imagination for a second. You woke up today to find yourself a Bitcoin miner. You have a mining rig to maintain, and you have an electricity bills to pay, and you have a hash rate to watch. So we know that Bitcoin miner have a ton of liabilities. But at the end of the day you calculated the cost of production of one Bitcoin. To find that one Bitcoin cost you 7K to be made, and Bitcoin price today is 15K, so you are going to profit after paying your dues. But in the next day, Bitcoin price dipped to 5K, and it cost you 7K to make one Bitcoin. What are you going to do? It's easy, you will hold, because you can't sell on lose. If you sold on lose, that will ruin everything. If you want the money in the moment to pay any bills, you will spend from your savings, or if you don't have, you will only sell what you need to cover the bill exactly, no $1 more. We all know that miners are big parts of the community, and there is 900 Bitcoin being mined each day. So you can imagine if all miners agreed to sell 900 each day, but some of them doesn't do that, and some of them are selling in continuous way if they are in profit. So the only thing that can force everyone to not sell is Bitcoin dipping below the average cost of one Bitcoin production. In this case, no one will dare to sell. They will tend to borrow to pay their bills, rather than selling anything and lose. So you now have 900 Bitcoin per day being mined, and none of them is entering the market supply. That will create a shock in the supply, driving the price to increase. In case you are wondering what a supply shock. A supply shock is an unexpected event that suddenly changes the supply of a product or commodity, resulting in an unforeseen change in price. Supply shocks can be negative, resulting in a decreased supply, or positive, yielding an increased supply. However, they're often negative. Assuming aggregate demand is unchanged, a negative, or adverse, supply shock causes a product's price to spike upward, while a positive supply shock decreases the price. That's also mean that the number of Bitcoin in the exchanges will decrease, making the liquidity decrease, so any buying will have more effect on driving the price up. I know that some people couldn't understand this point, but that is a more diving deep into tokens and fundamentals, more than just mining or crypto. So I will let that with coin distribution in another video. Now, let's apply this to the chart, so we can understand more. Since Bitcoin production cost is a variable, it's changed from day to day. We can sync this to a chart by making a line or a zone. If the price dips below this zone, we can know that all the miners will sell on lose. We will notice that this zone is working as a resistance area. When the price is going into it, it jumped back. Since the pressure of selling is its lowest, that's why I consider this model, which we turned it into indicator, is the best in case of predicting the bottom. Please remember that this model is to understand the tokenomics better, not to trade on it and use it as a sell or buy signals. That was the video for today. Till the next video. Goodbye.